Hello everyone, welcome to today's session. Let's get underway here. Start off with current market conditions. We're seeing market activity here as far as this bull market. We're seeing mildly bullish state right now where we're kind of waffling back and forth, up and down right here. S&P 500 chart, you can see this range right now. This is not the greatest chart, but you can see where we're at right now. We've kind of topped out right here. Now we've rallied back up a little bit off of these support levels, but we're still dealing with this upper range. We'll look at a little bit clearer chart here in just a minute and talk about some of the scenarios here. Momentum start weakening. We had one day up yesterday. We'll see if that continues today. Breadth is also still a decent, but weakening as well. And then sentiment towards the upper end of that range. Also this sentiment chart weakening, that 50% range right here, right inside of this zone. We want to keep an eye on that, see if it can continue to hold up. If it starts to slide through this 50% area, we could be getting again another market shift. That's one of the things to be watching. We're right at kind of an important area on the market. Let's look at S&P 500 because we've got a significant support area right here where we've got this low of that most recent bar, that down day we had right here. We're still inside of that range. So we'll see now today, you can see we just got a little bit of a bottoming tail bar on around that support area. So we're going to want to see support right here. If this breaks down and we break down through this low of that bar right there, and we end up probably going to have a quick trip to 506 on S&P 500. Notice what's starting to happen right here. Okay, notice this as this process is starting to unfold and this weakening is starting to happen. We're starting to get this perspective. Okay, when we're looking at individual stocks, this is the same process that we deal with on a retracement of an individual stock. In fact, I've got a couple of examples that we can go through and take a look at. But if the market starts to create lower highs, okay, lower high, if we break through this area and we can't get to a new high or an equal high, we break down, then it's going to be, that creates one rung to the downside. Okay? If we were to consider this, this is the top, this is the first rung of support resistance, this is the next one, this is the next one. We've already broken through one. Now we're attempting or testing this other one. So we want to watch this range pretty closely. It doesn't necessarily mean that the uptrend is over, but we just know how strong this uptrend has been, and it needs some pause. It needs a little bit of retracement consolidation. But that being said, the bias is still to the upside. Okay, we still want to have a bias towards a bullish bias with more upside, but with a limited position size. Okay, portfolio sizes should start to come down, in my opinion, just a little bit, meaning the cash positions need to be elevated. Right now we're holding what is that in this case, that's 76 on 120,000 portfolio. So we've got a decent percentage in cash right now and about 16 holdings. We had been as high as, well, 2 or 3 months ago, we'd been as high as 30 holdings and then 22, and now we're down to about 16. We just got stopped out of one again today. In fact, it was this one, CGNT, stopped out on a nasty move back down today. So some stops happening. Position sizes are naturally being stopped out. We're selling some positions here as well. Market conditions, that's what starts to happen towards these market highs as stocks just start to fail. They've typically been priced to perfection, and if they have anything at all that gives a little bit of a hiccup for the company, then the market will just slam the stock. So that's one of the risks of the market at these levels, is because we are so elevated that it's priced to perfection, and that means that things could start to break down when that doesn't happen as well. And we just, it's just there's some consumer numbers coming out. They may already be out that's moving the market. Those are still important factors. The inflation, interest rates are still an important factor. We're seeing bonds hold up just a little bit here today. This bar right here, this support, it's a 50% retracement of this high and this low. And you can see, this is obviously a downtrend for bonds. Okay, so a lot of upside work to do. We've got to see bonds break out of a lot of different things, really, for interest rates to be stabilized. If bonds continue to drop, that means rates are going higher. And for whatever reason, again, the CPI number, if that comes out as being really high, then the bonds are probably going to drop again, because that means that the Fed probably won't be increasing interest rates because inflation is high. CPI is a consumer price index. And so if the prices of goods and services are still going up, that is inflation, and that's what the Fed wants to control with interest rates. And so if interest rate, or if inflation is still high, consumer prices are still moving higher, then the Fed's going to have to keep interest rates high. So we'll see how that unfolds for the rest of the rest of this day going forward. Now, we could be entering into a scenario. This has happened before, where our new normal is 5% interest rates. Okay, the market just accepts it. Maybe it's 6%, maybe it's 7%. Maybe interest rates are not going to get any lower. Maybe they actually just stick around here 5 to 7%. That they were there for a long time during the 90s and early 2000s, and it's really just been the last 10 years, even more than that, 15 years, 14 years, since 2009 and 10, when we had their big financial issue and the financial collapse, and a lot of those banks and brokerages and insurance companies that were going under. Interest rates were, that's what really, after that, when interest rates really started to bottom out and tons of money came back into the system. So again, that's kind of macroeconomic perspective, but that plays a part. It plays a part in a slower motion in the stocks themselves. But we want to be aware of what bonds are doing right here, and we also want to look at that short-term bond SHY, which is the same story. So as of today, in this moment, nothing to get super excited about when it comes to interest rates. But we'll see. Again, we'll see what some of that data provides. We are seeing, one of the things that can rally in a inflationary type of environment are obviously commodities. Okay, so commodities have been doing pretty well. We're seeing silver having a massive run up. We're seeing oil having a massive run up. A little bit of a correction here today. That's good. We want to see a little bit of a pullback, some retracement on some of these. We're seeing steel, which is trending higher. We're seeing gold, which has been trending higher. Okay, so some of these things are continuing to move higher. We're even seeing wood products. Wood. So wood is forestry, timber. Price of wood is moving higher. So these things, these inflationary type of commodities, or I should say commodities, typically will increase in price in an inflationary environment. Because that's what inflation is. So we're seeing some of that also happening here as well. So those are going to be some of the areas that we're going to want to be focusing on, particularly if we see technology start to retrace, is what's happening in oil, what's happening with silver and gold mining stocks, steel, the price of steel going higher, the price of oil going higher. Those are two significant headwinds for economic growth, right? What are companies using to build and grow? It's typically steel. Okay, and what are they doing to move all that equipment and move their products and services? Oil. So those are added costs, and that's one of the reasons why inflation is such a negative thing for the economy and economics as a whole, is because it just creates additional cost, and that cost typically has to be passed on to us as consumers, and that's kind of the environment that we're in right now. So we are seeing stocks continue to move. Lots of different names, lots of different things that are moving here in terms of sectors and industries. We're seeing, we're continuing to see medical drugs, biotech continuing to work. There's always going to be something that is turning that corner, working on that new uptrend. We're seeing some interesting names here as well. Still seeing Royal Caribbean. There's a decent pullback. So I think this is actually this is either the beginning of a downturn, or it's just a healthy pullback on a lot of stocks that had big run-ups and needed a little bit of a retracement. So we've got an interesting week this week with a lot of these support areas needing to hold up on a larger number of stocks. If we take a look at this index scan and take a look at what's happening to the buy-sell ratio, then we're starting to see that weaken as well. Okay, minus the utilities, the Dow utilities, which has got almost all of them in uptrends. We're seeing more and more of these weaken. Okay, in this last 2 or 3 days, 4 or 5 days, this went from 6, 7, 8 back down to 1. Okay, so keep an eye on that as well. This is what market shifts start to feel like. They start to show up in this case, breadth, which is buy-sell ratios. Okay, we're seeing the number of sells, the number of buys. We're seeing more and more stocks pick up to that downside. More and more stocks pick up to that downside, and that I think oftentimes we think of a market and we look at, we don't really even understand what a market is. And a market, if we're looking at S&P 500, and if I were to go to this chart right here and say, okay, this is a market. Well, what does that mean? S&P 500. This is essentially, it's not exactly, but it's basically the average price of 500 of the largest companies on the planet. Okay, so the average price, it's a weighted average. So that's one of the issues that's happening recently is it's weighted towards only a handful of really large market cap companies. So those large market caps can move that. It's a market cap weighted index, which most of them are. There are some that are equally weighted and equally balanced as well. But in this case, this is what we have to envision is we have 500 stocks inside of the S&P 500. Well, if we were to look at now of that 500 stocks and we go to the index tab here and we say, okay, S&P 500, let me just highlight this and we'll look at this. Okay, buy-sell ratio 1.3. We've got 100 down, 165 to the upside, and about 150 that are stuck in this hold range. Okay, so we know that it's almost, it's a little bit more, 165 to 100. So that's that number right there, that 163. In this case, it's pretty good math. So as we're seeing that, now this is what the market of the S&P 500, 100 of those stocks are in downtrends. Okay, and 165 of those are in uptrends, and 146 are flat. Okay, so this buy-sell ratio, if it were to be 1, then we would have an equal number here, an equal number here. Okay, and then probably a very close to an equal number here. The holds really don't matter because they're in transition. We've yet to really get a good solid move one direction or the other if everything is in hold. But it's a transition. They're transitioning from one trend to another. So when we start to see this, we obviously can see that in price as well. When we get down days on S&P 500, and that just means that the average of all of those stocks right now is down 0.36. Some are up, some are down. Okay, but the average of the entire group. So it starts to matter when we start to see what are the internals telling me on this price action, this price activity. And we can go to two different places. We can go to buy-sell ratio, which in this case is the full database, and it's giving us some of these numbers here where you've got buy-sell ratio is about 1. Well, we knew that, and we also knew that most of these indices are also going to look like a flat buy-sell ratio. Okay, this is a tug of war. When we're uptrending, we're going to have a lot more stocks in buy signals in uptrends than we do when we're flat. So we're looking at additional clues, additional indication of what's happening in the market as a whole. Now, obviously, we can just look at the chart of the Qs or the S&P, but if we want to be able to take just a little bit different perspective or an additional perspective by looking at buy-sell ratios, we can also go into sector scans and start to look at what sectors are leading. We've still had construction and aerospace. Construction's just been leading since October, I think, and has been the highest ranked group. Now remember these ranks, this average rank right here is telling me the average rank of all of the stocks inside of this sector. Okay, so the average rank of all of the stocks is 73. The average rank of all of the conglomerate stocks is 35. Okay, consumer staples is 38. So the average rank is pretty low. Once that starts to climb as well, then we know that we've got a sector starting to shift, and we're getting these lists of stocks that are starting to move higher as well. Okay, and so we haven't really seen, we've seen oil and energy start to move. And one of the things you can do also is if you're just curious, you can go click on the date button and go back. So if we were to go back, a month and then scan and pull this in, that's going to tell us what the stocks and sectors were on that date. Okay, so we can sometimes go back through and say, okay, a month ago we had construction, we had aerospace, we had utilities, we had consumer or computer and technology business services. And now if we were to run that, okay, we're getting really nothing changed. Okay, let me just refresh to make sure. But that's one of the things that you can look to see if there was a change in that. But for the most part, you know, it's just a quick glance and you can say, aerospace construction, what are the 41 stocks in that construction sector that I may want to focus on? Well, let's look at the top one here, Dreamfinder Homes. Okay, in that leading sector, it's been the best performing stock in this last year. You know, really having a big run, a pullback here today as well. But again, inside that upper momentum zone, this is what breakdowns, retracement, retest start to look like. We'll see if we start to get buying now pulling into these some of these other sectors. But that could start to shift. Okay, that this sector could be starting to shift away, particularly if interest rates are looking like they're not going to be going lower. These are all home builders or building or construction of some kind. Typically, they need lending, right? They need mortgages to be able to fund all of this, and or debt to be able to fund a lot of the growth. Or you know, in this case, the consumers have to have a mortgage to be able to buy a home from these guys. And so if that's becoming harder and harder for consumers to borrow, then some of these stocks may also be affected, and that's happening today as well. So a quick glance over at sectors is always interesting. A scan to be able to focus on. And then I like the scan ETF here because I like to just do this quick sort and look at the numbers right here and say, okay, this also is corresponding to the perspective of breadth and market conditions that are a buy-sell ratio of 1. It's flat. Well, it's flat because we have all of the, you know, we have these sectors that are also showing that it's relatively flat. Some are up, some are down, some are hold. That's going to create a flat market environment. And it's been happening pretty quickly. You know, within a 2 or 3 day period of time, one trend can bump all these back up to up, or can bump all these back down to down. Okay, so it is at an area where we want to just be aware of what the market's doing. Now, can we ever anticipate, can we ever predict it and say, this is the market top entirely? I can't, you know, I'm not very good at that, but there may be some people that do or that get lucky. But in terms of, I don't think we have to do that either. I think we miss out on a lot of things by being scared and saying, we're at a market top, we're just flat out going to sit on our hands. If your risk tolerance requires that, then by all means do that. Okay, if you're trading or investing and you're not comfortable with the way that the volatility is happening in your account, then you've got to reevaluate your risk tolerance. And typically, you know, you go back to the old financial planning days, and it's, you know, you should have 3 to 5 years of cash available to you. Okay, so if I have a job and I earn $50,000 a year, okay, I should probably have at least 150,000 of my assets, if I need this money relatively soon, in cash, okay, not invested in stocks. So if I have, you know, if I have a $250,000 portfolio, then I've got a pretty big percentage of that still sitting in cash, and the rest of that probably in other assets or other things that, you know, stocks or bonds or whatever it is I'm trading, ETFs, a different allocation across the board. But that's very important when it comes to managing risk. It's always about managing risk. The market's going to do what the market does. It's going to go up, it's going to go down. Ultimately, stocks are designed to go up because companies are designed to go up. Companies aren't built to fail, right? They do, but they're not built that way. And when a company really figures it out and becomes profitable, well, the value of the ownership of those profits are stocks. Okay, they are. It's a way for us to be able to participate in Royal Caribbean's profits. Okay, if these guys have an annual earnings per share increase of 200%, and they're really growing, I want to be able to participate in that. Well, the stock price is going to reflect that. But I've got to have a company that's either making money or anticipated to make money. You may have companies that are going up but they're not making any money because everyone expects them to make money. Maybe it's a biotech and they've got a new cool drug that is that's about ready to go on the market, but they don't have any revenue yet. Well, they're anticipated to have revenue. And so a marketplace of stock buyers and sellers, which is what we are, we're just a marketplace that has come together to say, you know, we all believe, the entire planet believes that Royal Caribbean is now worth $131.72. Okay, in 10 seconds, it's going to change. This may be 71. This may be this bidding process is a marketplace, and that's what is determining the value, I should say the perceived value of this stock. It has an intrinsic value. It has value that it's producing X number of dollars in revenue. It's got X amount in net income. Okay, that's the intrinsic value. That's what it's actually producing. But markets don't judge that the same way. Markets say, oh, if they're making X amount right now, then we are going to anticipate that they're going to be making that or maybe double that next year. And so we're going to buy the stock now based on the fact that it's growing and based on the fact that we think that that company as a whole is going to continue to produce revenue. Now, this PE ratio, PE is a price to earnings ratio. So this price is 20 times higher than its earnings. Okay, so this is called a multiple of earnings. So right now the market is saying that for Royal Caribbean, it's okay with a price to earnings ratio of 20. So the market is willing to pay 20 times the earnings. That is going to change at some point based on new information, based on the economy, based on consumer preferences to travel, based on a ton of different things. And stock market participants are going to they're going to adjust based on this new information that is known or that's anticipated. They're going to make this adjustment every second. Okay, they're deciding every second what the value of these earnings is going to be worth, and that's the game of the stock market for us as traders and investors. Is we're trying to anticipate what the value of a company is going to be worth in the future, and we want to be able to buy it now in anticipation that it's going to be worth more. Okay? And so we use trends, and we use data, and we use rankings, and we use all of these different things. Number one, to help us find a company like this. Okay? I want to be able to find stocks that I know are working, that are growing. And so the rank, new buys and a rank, is giving me those stocks, number one, that I know that they're moving up with a stock chart as a whole. Let's see if we can find any name brands here. Murphy. Let's see if this is Murphy Oil. It is, but let's come back. See if we could find. Here's Wells Fargo. Okay, so Wells Fargo. We all know Wells Fargo. Okay, banking stock continue to move higher, and as it's kind of flattening out right here, and we're trying to decide, do I want to put some of my capital to work in a stock like Wells Fargo? Well, if I do, then I've got to determine, number one, how many shares am I going to buy? Number two, where am I going to exit this stock if I'm wrong? Now, there's two schools of thought. We just talked about this morning, actually, in our Discord channel, because we've had some stops from January 1st till now. We've had a lot of stops of stocks that they're moving higher, or they just get some of these really crazy moves like this, where you've got a stock that looks something like, let me pull it in here and use this as an example, like this one. We've had some stocks that they've been doing really well, and then they continue to climb, and then bam, they just gap lower, and we get stopped out of some of those. Well, that happens. Okay, that's just the nature. We're taking risk, and sometimes we're taking more risk in companies that are unproven, or they're just flat out momentum stocks. That's part of our system. That's the main part of the system, is we're looking for momentum trades. We're looking for stocks that are moving this direction. Okay? And then from there, we've got to decide how we're going to manage the risk on each of those individual trades. So if I go back to Wells Fargo, if I can find it here. Delta Airlines. I'll go to Delta because that's Delta Airlines. So my point being, how would I have known about Delta being in an uptrend It's currently sitting in the momentum zone with a, doesn't have a great rank because we scrolled down quite a ways. Okay, but if I wanted to be able to have a filtering mechanism to find certain stocks that are doing certain things, then I've got to be able to have that, right? Otherwise, I'm just continually guessing of stocks that I only know of, and there's thousands and thousands of stocks, and I guarantee you, we don't know all of the names of the stocks or what they do or how much money they're making or if they're in an uptrend or if they're in a downtrend. There's no way for us to know all that information without having a scanning mechanism to be able to find what it is that we're looking for. So that's step number one, is we're looking for stocks that look just like this. This is Delta Airline. It's moving higher. We want to see a stock that's in this upper range. In this case, a retracement, a pullback, a little confirmation move back up here. I don't have any volume on this yet. Let's add that in. Okay. And so now I could say, oh, I want to buy Delta right here. What do I do now? Well, I've got to determine the number of shares that I'm trading. So if I go in and I say, if I have a $100,000 account and I want to buy Delta right now, okay, then you can start out by using the portfolio at risk. I like to use 2 to 2.5% because I like to buy a lot of stocks, and I typically will filter through a lot of stocks. So I want to make sure that the risk is manageable. Now, I personally could handle probably a little bit more than 2 to 2.5%, but when we're going through these, it's a really sound number to utilize for risk management. 2 to 2.5%. Let's look at that. So let's say if I bought 100 shares of Delta, now let's do 50 shares. So 50 shares of Delta at a price per share of $47.19. I'm placing at risk $2,359 or 2.2% of my portfolio. Okay. If I'm wrong because I don't have a stop loss and Delta drops to zero, okay, what are the chances of that happening? Slim to none. Okay. Then I'm going to lose $2,000, or I'm going to lose 2%, 2.26% of my 100,000. That's the worst case scenario. Worst case scenario is I lose all of that money. Okay. I want to start out every trade with my risk management of the worst case scenario. Okay, worst case scenario, I lose everything in this stock trade. Okay, that an asteroid would have to hit the planet or something, something drastic would have to happen for that to happen. So I know that the probability of that happening is not very high. The possibility could have, it is a possibility, and on Delta maybe not. But on some stocks, like some of these smaller tech stocks and biotech, and that certainly can happen. We've experienced a 50% gap overnight as well, and they hurt. But it's only a 1% loss. Okay? If I have $10,000 in my account, I better be trading 5 shares of this, and I better have this be my number, my total number at risk, $235. Now, that we obviously know that we're not going to trade like that. We're going to have a stop loss in place. So if we place our stop loss just below this number, I like to use this 236 as a stop loss, which is that Fibonacci tool. Okay, we've got a bottoming tail bar right there. It's a little bit hard to see with that shadow, but 44.91. Let's place a stop just below that at 44.75. So if I go 44.75, okay, let's bump this back up to 50 shares. So now in this case, I'm saying that I want to exit. If for some reason Delta did this, it moved lower, and it got to this level, I'm just saying that if it gets to this level, I've got to follow my system. I've got to follow my plan, and I've got to exit that. I've got to sell out. I want to have a stop loss in place. 2 things can happen. 3 things can happen, but two are going to happen. One is it's either going to go up or it's going to go down. The third thing is it can kind of flounder here, but eventually it's going to go up or it's going to go down. Okay, so if it's not going up, which is what I want it to do, then it's not working and I need to get out of it. There's no reason for me to sit around and wait and hold on to it as it drops, and then it's like, oh crap, well, all right, I guess I'm in this for a while now. And yes, stock like Delta probably is going to recover. And if that's inside of your trading plan to say, I'm buying, instead of 50 shares of Delta and having a stop loss, I'm going to go no stop at all. but I'm going to buy 30 shares of Delta. Now I'm buying $1,000 worth of the stock. I've got 1.36% at risk and 0 stop loss. So I'm buying this and I'm holding on to it, and I don't care if it drops, okay, or goes up or down. That's kind of a long-term investment approach. Is I'm buying it. Worst case scenario is this goes away. Best case scenario is it goes up, a few thousand%, but I buy 20 of them. Okay, instead of buying one with 10,000, I buy 10 with $1,000 or $1,500 each. A little bit more diversification across different names and different holdings. Okay, so now we've got our risk taken care of. That's our job. Our job is to manage risk. It's the stock market's job to make us money, okay, or lose us money. We have no control over the making or losing part of that trade. All we can do is control when we enter, why we enter, and what are we going to do if we're right, and what are we going to do if we're wrong. Okay? And what does that mean in terms of money? Okay? That's always the granddaddy. Is like, you go into a trade and you don't know exactly, I'll just buy 100 shares. And then what? When do you sell? When do you buy? When do you stop out? When do you keep your shares? When do you take your profits? Okay, that's not a system. A system is being able to understand why you're doing what you're doing, and then doing it over and over and over again. And with stocks and using this method, we're going to have losers. It's just the nature of the market. And we're going to have market conditions like right now, where, from January 1 till now, really the portfolio and the market as a whole has been relatively flat. And that's not surprising, because there's going to be these transition shifts where we really get a good solid uptrend, and we can capitalize on that. Or like we did from October, November, December. From January on, it's been relatively flat. Eventually, market's going to turn down, or it's going to turn back up. It's never the same, okay? And so we want to make sure that our system of risk management is always the same, because the market conditions are never the same. They're every day they're different. Every stock, is going to be different. The economy is different. That's part of the fun part of the stock market, is it's always the same thing, but it's always different each day. So we can go into every day with kind of a different perspective of, yes, I want to do this process over and over, but today's a whole new day, whole new group of stocks, whole new set of ideas that we can utilize. So I wanted to spend some time on this, and I'll spend more time on this in the future, because in my opinion, it's the most important part of investing in stocks that you can understand and then implement. Because if you haven't had any success, or you've had lots of inconsistency, this is probably the number one reason why, because you don't know why you're entering, where your risk is, and then when you're getting out and why you're getting out, either with a winner or a loser. And that's really what we want to be able to provide for you, is just a systematic approach to be able to look for uptrending stocks, when to get into those, how to manage your risk, create a portfolio of stocks that ultimately go higher. Sometimes they don't, most of the time they do, and especially if we're picking right market conditions, right stocks, and we let the software guide that for the most part in terms of which stocks are coming to the top. We can filter that down a little bit more, as I've mentioned, by creating different scans inside of our screener here, like we did this live class screen the other day, or a couple weeks ago actually, where I went here, and I think we added in a couple of other things: increased market cap, increased volume, increased PE, or at least a PE number. So if your number of stocks are too big, or if you're dealing with stocks that are really gappy, like for example, although that, it doesn't matter what the stock is, because even Apple and Walmart and stocks that trade millions and millions of shares will have a negative earnings report, or some new litigation, or an antitrust thing, or you name the problem, and companies can gap lower, even if they're mega cap stocks. So that doesn't always prevent us from that. Buying a bigger, more stable company doesn't always prevent us from dealing with gaps. But for the most part, you're going to deal with less of them if you're dealing with really, really large, stable companies. And you can create that inside of your scan. You're still going to get stocks that are moving higher, still going to get stocks that are in this uptrend. You're just getting a lot more stability and solid companies if you're increasing the size, number one, you increase that market cap. This is $55 billion market cap. The average volume is 11 million shares per day. Okay, so really, really big, you know, we're talking big numbers. The bigger the numbers, the less volatility you typically get in terms of the unknowns. Okay, lots of things are going to be known because lots of people are paying attention to a stock like this. And that's simply just a scan based on market cap and volume. Those are the two big factors that are pulling those stocks in. I'm still going to use hold to a buy. I'm still going to use ranks, still going to use all those things, but it's just going to filter out maybe some smaller companies that add additional risk and additional volatility. Okay, so lots to digest in that session today, but I'm going to end on that note. I appreciate everyone's time and effort, and we'll see you next time. Have a great day today. Bye now.